Well, unsurprisingly, the Fed has left rates unchanged. The surprises, if there are going to be any, are probably coming out even as we speak. We're going to monitor some of the earnings activity today on open interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Rather soft day for equities generally, but really all of the news for today is coming out after the close. And you're going to hear chimes in the background, I'm sure, as I start to get some of that. And yeah, so we had some positions in Amazon. We had positions in Microsoft and several of these other names. And this is the biggest week for earnings releases of the earnings season. 47% by market capitalization of the S&P 500 is reporting this week, and much of the bigger reports are happening today. So we're going to kind of monitor that and see what is going on as a result of it. Before we do that, one of the things I thought I might talk about is a trade. Now, I had written this up, so I don't know whether this actually made it out into print or not. But I thought the study itself was interesting, and we should probably talk a little bit about the way you can think about how a trade performs when you're looking at it. So yesterday, I'm just going to do this. If you're looking at my screen, so we're looking now at Trade Alert. Trade Alert is one of the data feeds that comes from the SIBO, and it's just a way that we can drill down into some of the unusual trading activity. I mean, we've seen this from various platforms. You guys have seen me do this work in Bloomberg, for example. So I can go back and see. I can go back one day, I believe, in here. So today, and I can go last close like this, and what I had noticed, just making sure it's on the right. Did it actually go back? Did this thing actually go back in time? I don't know that it did. Let me see here. Oh, yes, it did. Okay, so yesterday. So we'll look at yesterday, and then we'll look at today. And this is really going to be more of an educational thing about trades you can do. And we're going to find out how this works in real time, because we're going to find out how Qualcomm actually does, because they're reporting right now. So this popped up on Trade Alert yesterday as, I think, the third highest in terms of unusual volumes, single stock options volume. And this is basically a synopsis of what was going on there. Okay, so you can see here that it was about double the average day. Double the 20-day average volume. The other thing you can see is that calls outpaced puts, in this case by more than 3-1, and it was the 160 strike calls. And the implied volatility, as we look over here, we could see that the implied volatility suggested that a lot of that activity, which we know was opening. How do we know it was opening? Because you can take a look at the volume. You see the volume traded 14,000 contracts. There was only 7,878 open interest coming in. We could fast forward to today, a lot more of this activity. It's just things you can monitor at home. Maybe you don't have a Bloomberg terminal. Maybe you have another mechanism to do it. So you can, if you have this, if you happen to have something like Trade Alert, that's almost certainly going to show up in here as well. There it is. So you can see that the volume was big yesterday. It was bigger today. Pre-earnings, almost 5 times the average daily volume. And today, once again, calls outpacing puts by about 3-1. If you don't have this, it might be a little harder to do sentiment analysis, but we can see this basically takes a look at every single trade that took place during the day. You can see that bullish bets outpaced the bearish ones, but that's not really what this is about. What it is about was, and I'm sure you guys have seen me do this, so I'm going to pull up Options Play now so we can, whoops, where did I put my Options Play? So I'm just going to get a new browser in here. I accidentally closed that. Sorry about that. Busy day today. So admittedly, and this coming rapidly after the close, I wasn't completely prepared, as I should be, having everything queued up. And we'll go like this, pull up options play. So maybe you have a system that tells you what the implied move is on earnings. Maybe you don't. But if you don't, that's okay, because this is something you can calculate yourself. How do you do that? Take a look at where the stock is trading. Go to the at-the-money straddle that is the nearest expiration following the event. The event is today. Nearest expiration is obviously going to be, in this case, Friday. So we can just back off to the May 1st options, and we add the call and put at the money. Take a look at what these two things add up to together. Stock's about 155, and there's our magic number. So the magic number, in this case, $12.38. $12.38 was essentially the implied move. So that's almost 8%. 8% move for Qualcomm in just 2 trading days. And to put things in perspective, when I bring my Bloomberg back up, which is going to have the history of these events, we're going to see that that is a bigger move than the stock has historically averaged over a fairly long period of time. So right here, that's the number we're looking at, 5.5%. What does that tell us? Options are expensive. So when options are expensive, they're elevated because of the event, but arguably they are more elevated than they needed to be, could have been, should have been. Sentiment was bullish. So why else might sentiment have been bullish? Well, we had some interesting news out. Let's see if I can find that. I think you'll if you didn't see this, but it's more compelling if you see it in print than if I just tell you. Some of you may know what the rumor is. So let me see. Okay, well, here, this is interesting. So they give a week forecast. This is good news. Smartphone market slumps. Now, it relates to this. Misses their estimates. Their estimates were already weak. They reported 265 versus consensus. How is that a miss? They reported 265. Hang on a second. I apologize. Got CNBC ringing me up on the backside of all of this. All right. Sorry about that. Make sure this is also muted. There we go. So, yeah, 265 actually beats the number that I had seen. We can go over here. And if, I'll show you what I was looking at. So this earnings, the earnings trend number. So right here, okay, there we are, okay? So this is, Bloomberg hasn't updated it with the actuals yet. So this was the estimate, 255, at least as far as Bloomberg was concerned. That was what the consensus was. And they just reported 265, which looks like a beat. Did they have a miss on the revenue line, one wonders? But, and whether this wins or loses, I'm going to tell you about the trade that I was thinking about at the time. Okay, and here we are. So if we look down here, this, for the moment at least, is about where the stock is trading, 145.80. Why is that important? I will tell you. Because when I was looking at this yesterday, I thought, well, the options premium are a little bit elevated, and a better way to play this on a modestly bullish bet would be to sell the 145 puts. Okay? So the May 145 puts. The May 145 puts, yesterday, when I wrote this up, were trading for about $5. Let's see where they traded throughout the day today. See if we had an opportunity in there. Oops, I should do GIP2. So, oh yeah, they were trading. That's about where they opened. Let's go GIP2. So these were about a $5 option when I was looking at this yesterday. And actually, they traded as high as 7. But my thinking was that a better way to play Qualcomm going into the print was to sell the May 145 puts for about $5. You would yield about 3.3% of the current stock price to sell a put that was at the time, because it closed almost spot on 150 yesterday, for about 3.3% of the stock price. What that means is the downside break even was 6.6%. So just to frame this up a little bit more clearly, had you sold that put, so we'll go out to May regular way, get rid of this, sell, put 145s at 145, you get a payoff that looks like this. The downside break even in that instance would be 140. So down 6.6%. That's the downside break even. You're going to make anything above that. 3.3% over the course of 16 days. Which is quite a nice rate of return. I don't think I need to tell you. Right? So that's going to be better than 70% annualized, excluding slippage and transaction fees. But, and it's trading one, where is it trading now? I'm just hearing a big high number. Oh yeah, so let's take a look here. So that was certainly a nice trade. But here's the thing so you can see that it went down and then started to pick up. But here's how I want you to think about this, okay? So the way to think about this, there's two ways to do this. One is to say, okay, if I can sell a 3.3% out of the money put on Qualcomm for 3.3% of the current stock price that expires in 16 days, what is the expected return of that over all the data that I have available? So I'm going to create a spreadsheet right now. And in this spreadsheet, we're going to go through a couple different exercises as ways to think about it. And I think maybe the most compelling of these is simply to compare what selling that put would do compared to buying the stock. So a handy feature that I happen to have available is that I can actually say, okay, how did this behave from right before earnings? So I'll go from, I don't know, -1 to 16 days after, because we were looking at this yesterday. So this is the performance of Qualcomm going back 11 years around earnings that way. So I'm just going to dump this into an Excel sheet, and then we're going to just evaluate how to think about the performance of a strategy like this. Okay, so now all you're looking at right now is just a table that, and I'm going to sort this because I want to create a time series. So I'm going to sort this from the oldest to the newest. All right, as a number. That sounds good. Okay, so there's a whole bunch of stuff in here. We can see the estimates, and in fact, a lot of this is just noise. And because I don't want you guys to be too distracted by, do you really care what the guidance was back in 2015? You don't, right? If you want this, maybe we can post it somewhere, but I'm pretty sure you guys don't care about that. So I'm gonna hide all that. What we are actually doing, and do you care what the PE was then? No, that doesn't matter either. So we're gonna get rid of all of this. In fact, you don't even care about the guidance surprise, right? So all we're really looking at, this was the period that was being reported, this was when the announcement took place, and this is how much the stock moved on that day through the next 16 days. Now, here's something you can do. Since Excel isn't completely recognizing that as a number, and that it usually does when you refer to it in a cell as a formula, but not always. Okay. So those are the returns, all right? Now, let's say you took $100 and you said, on the day before earnings, I'm going to buy the stock, and by the subsequent regular way expiration, we'll call it 16 days later, I'm going to sell it. So that's just an investment strategy. How does that perform over time? So that's going to be equal to that times 1 plus the price change over that period of time. How did that do? So you end up with a return stream that looks about like that. That actually looks better than I remembered it when I looked at it. So let's just pull up a chart. Not bad. Okay. Now you say, well, what are you talking about? This goes back 11 years. It's 11 years, but really what we're doing is we're just sort of saying, how would it have done if I had simply bought the stock and held it for 16 days thereafter. Bought it right before earnings, held it for 16 days. How'd I do? So what's that put worth? Well, the put was 3.3% out of the money. So the put is going to be equal to the maximum of 0, because an option can be worth 0 or it can be worth some number greater than that. So it's going to be worth either 0 or the strike, which in this case was minus 0.0331%, less this number, the price change. All right. So hopefully I did that formula right. Oh, actually, oops, this should be percentages. It's not dollars. So there we go. All right. And now the return, if you sold that put, remember it is whatever the put is worth. So you're going to get the value of the put minus what the put is worth. So this is going to be equal to what I sold the put for, which was, again, about 3%, less this. So when you sell a put, you are going to collect the premium provided that the stock stays above the strike price. If it falls below the strike price, you are going to essentially take the risk of owning the stock. Let's see. Get a different kind of return stream here. And so this is how selling that put would have done. Okay? So, in percentage terms, you would have done better selling premium going into the print than you would have simply been buying the stock. Stock did okay. The total, this is in this history that we're looking at right here, this is 44 reported quarters, and it's 16, 17 days, we'll call it 17 days, 748 days that you would actually be in this position net. But I thought it was kind of interesting and illustrative of how a moderately bullish strategy that looks to harvest some options income can behave relative to the underpinning stock. And here, I mean, you can see that the difference is fairly profound, right? So one returned 15.6% over 748 trading days, positions held. The other 156 bucks, so 56%. So 15.6 versus 56%, not really very close. And I think if you look at these two charts and you say, okay, well, I can make a bigger percentage in here, and what might make this look even a little bit more interesting is if I format the axis so that we can just take this one down. I'm going to make this one, we'll make the minimum on this axis for illustration, we'll go $70. And I'll do the same here. And we'll compare them. I should put them side by side, but I think it's kind of, this sort of tells the tale, right? So you win more often. This is not surprising because if you sell a downside put at an elevated premium, three things can happen. Stock can go down sharply, it can remain relatively range-bound, or it can go sharply higher. And in this scenario, 2 out of the 3 are going to be money winners, and 2 out of the 3 will outperform long equity, right? So when you think about that, these results might not surprise you quite as much. I should just get rid of this chart title. That's not helping anything. There. So, and when I say, another way somebody once put this to me, they said, in this situation, 2 good things can happen, and 1 is less bad. And what they mean by that is, if you sell cash-covered puts at an elevated premium going into a catalyst like this, The stock can go sideways. That's a win. The stock can go higher. That's a win. Or the stock can go sharply lower. That's a loss. But because you sold a 3.3% out of the money put and you collected 3.3% of the current stock price to do it, no matter what happens, you cannot lose as much as a long position in the stock would have because you are buying it 6.6% lower than the spot price was when you initiated the trade. So even if the stock went to zero, you would lose 6.6% less capital, assuming you size the trades equivalently for doing the cash covered put sale versus buying the stock. Now, I will say that when people reflect it that way, three things can happen, two are good and one's less bad. I would say, well, one's good but not as good, right? Because if Qualcomm rips, you can crush it. That's what happened here. Qualcomm did really well in that period, and it did really well in that period, right? And if you look at the equivalent period for selling cash covered puts, you did not do as well. You kind of got this grind higher, and same thing here, right? So you had this setback, not as bad, and then you ground higher. But, it's a slower, steadier, and you have that tailwind. I just thought it was really interesting and illustrative. I wrote the article. I had asked CNBC to publish it. I am not 100% sure that they did because I didn't see. I looked for the article and it might be on the website someplace. I'm not exactly sure where. But this is the point that I was trying to make. And I think it's an important thing for everybody who's watching right now to think about, to consider. And I also was hoping that in doing this, and I need to bring this up because I don't bring that over here. Your comments, which I forgot to light that window up as well. I thought that was going to be a helpful way to think about it. All right. Ethan, smiley face. Well, thank you. Same to you. Thanks for joining us. Finwest, good morning, Mike. Busy week for earnings trades for sure. I'm not done just yet. SanDisk and Apple. Gosh. Yeah, we have positions in SanDisk too. So we've got positions in Chippy, Soxy, Biggie. Do we have it in Ulti right now? Where do we have? I mean, we have SanDisk in several funds, and I know we had some chips in here. Do we have it here? Yay or nay? We don't have it in Ulti at the moment, but we have other exposure, of course, in chips because we've got NVIDIA and we've got Lam and some stuff like that. A lot of, we were talking about SanDisk, I think, here on the channel recently. Somebody was asking about it. And the point I was making is, like all of these companies, it's really hard conceptually for us to get our arms around these kinds of numbers. 60% net income margins is what the streets forecast for the full year upcoming. And when I say the full year upcoming, it's because their fiscal year is about the next 12 months, basically, almost. Ends in June of next year. These kinds of numbers are just really, really hard to get your arms around. I don't think these kinds of numbers, honestly, are long-term sustainable. But the stocks are not priced like they are either, right? So if you're looking at this and you're saying, okay, well, I'm going to think about that as being next year's earnings, and I've got this thing trading at 8.7 times forward, that's basically the street telling you they're going to print money while the getting is good, but the getting won't be as good as that forever. Another quick way you can see that is take a look at the anticipated free cash flow yield for next year. $156 billion enterprise value and $19 billion in free cash flow anticipated with margins like that. Not surprising. That's 12.2% free cash flow yield. Wow. It's really quite remarkable. Okay. So, all right. Seems like the call-put ratio is usually positive, especially if the stock has been beaten down. Is selling puts basically the only game left in markets? So, here's what I would say about this. And I think, we have had such a tremendous tear in equities. let me just bring us back to this. I've shown this chart before. Maybe some people watching now haven't seen it. And this is a chart that J.P. Morgan put together. I'm sure others have done the same, but I thought theirs was good. I'm going to bring it in. And really, the section that I want you to pay attention to, not so much this section over here on the left. That's not as important. This section over here on the right is the part, I think, that really deserves to be looked at. That's over here. Okay. And this is, it's a little stale. This is from January, but it's not so stale that it doesn't that this doesn't bear examining. One of the things what is this chart of? It's a scatter plot along the x-axis here. As we look down here, what we're looking at is the forward-looking price to earnings multiple. So what the street's anticipated earnings are for the S&P over the following 12-month period, plotted against the subsequent annualized returns over the next 5 years along the y-axis here. And what this shows, this is this little trend line that we got going here. And let me see if I can remember how to make the line. Is this the line? Yes. Oh, sweet. I'm getting better at this. So what we're looking at, what this line is showing, is that the less you pay in terms of multiples for stocks, the higher the annualized returns are over the course of the next 5 years. Makes sense, right? I mean, even if the only returns you got were from distributions, imagine you bought a REIT or something where 90% of the profits were distributed back, or a bond. The higher the yield, in this case the earnings yield, and the earnings yield is the inverse of PE, so therefore the lower the PE is, the higher the earnings yield, the better your annualized returns, your total returns turn out to be. Makes good sense. Now, what's a little bit alarming, and what a lot of people and analysts have been paying attention to, is this, and that is that the forward multiple for the S&P is higher than average. And when you're paying a higher than average price for stocks, the returns over the subsequent 5 years tend to be less than usual. Now, if that's true, then does put selling become the only game in town, or buy rights, or options income strategies, that sort of thing? Well, one thing that I would expect is that the relative performance of options income harvesting strategies relative to straight long equities, that relative performance is going to improve. And it should make sense that it would, because you're going to be getting a constant tailwind. So you're not going to see that same kind of 20% year over year stock price appreciation gains that the previous period had revealed, coming out of the pandemic low or whatever it was. So I do think this is something that folks should have in mind. I think a lot of things contributed to the relative underperformance of some of those types of strategies in recent history, even though in the longer term history they had actually stacked up very, very well. We had ZIRP policy. Not a good idea. Caused inflation. Accelerated the price appreciation of risk assets. We can see that when we look at something like a long-term 10-year chart, and we get something that looks like this, and we see unnatural rates that cannot be true, that cannot last, and that don't represent a market reality. So right here, 10-year rates at 0.5%. Okay, it's an artificial rate. It wasn't realistic. Monetary policy was a bit silly, and it caused significant appreciation in risk assets, right? So that's a problem. We're out of that. So I expect equity price appreciation to be slower over the next 5 years than it has been over the last 5. And I'm not alone in this. The data bears that out. I do not expect to see interest rates fall to the levels that we've seen in the last 5 years, and certainly not the last 6. And I bring up the last 6 because it was really 2020 when we got down this low. But even, what we saw back here in 2021, these levels in the 1.5% range in the tens. Yeah, I don't think that's going to happen. And if that's true, then of course that also is going to suggest that risk assets are not going to appreciate as quickly. There's a lot of other, strong things that could help. Now, in defensive equities, it should be said that an important aspect is the potential productivity growth that could accompany all of the developments on the AI side. And I think we are going to see that. But, so much good news has been priced in there. So much. And a lot of that's also in the private market as well. So, you're not even, you buy the S&P, you're not necessarily getting that. You might be buying, if you bought the S&P in general, what you might be getting is some hope for and anticipated in productivity improvements. And a productivity improvement accrues to capital, not to labor, right? So from an investment perspective, that's definitely a positive. So again, I am in support of this notion that options income overlay strategies are likely to do much better on a relative basis over the coming years, which is one of the reasons I showed the Qualcomm trade. And I also wanted to show you, how to think about that in terms of performance. Now, here's something else. There's another way we can look at the exact same idea. And that is that you can do an analysis of how a stock has performed over any period of time. Now, this is a little bit different. I can't do this sort of cumulative time series type of thing. But let's do this. One. So I'm going to now, instead of what I was doing there before, I'm just going to examine the returns over, let's call it a 17. And I haven't quite done this one yet, so we're going to do this together. Oops. Maybe we are. A1, B1, C1, D1. What did I do wrong? Qualcomm equity, I got that right. PX last. Today's price. Did I do that right? Maybe I typed one of these things in improperly. Ah! Oh no. What just happened? I lost. Thank you very much. An astute individual just observed that I lost my Bloomberg plugin. That's great. Why did that happen? Do I have it here? What the heck just happened? Where did my, that's really strange. And that's really annoying. Because that's going to make it, not going to be able to troubleshoot what just happened there. So, I guess that is going to have to be an exercise for the next time we do this. I'll tell you basically what I was going to do, and from that, how you would do a little bit of analysis. So essentially, what I was going to do was just come up with the time series of prices. So I was just going to drop all of the prices for each and every trading day. Then I was just going to take a look at a rolling 16 calendar day window of returns. And then I was just going to choose the strike of the option that I was looking to sell. That was the 3.3% out of the money put. And I was just going to value that put over the course of time. Like in its entire history, how much has that put been worth if you could have put it on every single trading day in Qualcomm's traded history? If I could sell a 16-day put on the day of their IPO that was 3.3% out of the money, and each and every and any day thereafter, and I put all of that, stitch that whole thing together, I'm going to come up with an average value for that put, right? And I can then compare that to the value of the put in the open market. And I did this work yesterday when my plugin was actually still working, which it is not now. And what I was able to see was that I think the average value for that put was something like $2.93. and you could sell it in the market for about $5. It's a way to think about the value of an option. Is it the right way? Not necessarily, because an options price is based on the notion that you can continuously hedge and the idea of synthetic replication. But in another way, you can think about it like that in a sort of a real options pricing model sense, which is that if at any point in time I could sell that put for that much money, and I averaged every single trading day over the course of the last, 30 years, how would that have performed? And you can see that the returns would have been positive. Now, the reason I showed the earnings one first was because that would be stitching all of the potential moves over its history together. We'll actually look at this. So, in other words, if I'm looking at Qualcomm as far back in time as I can possibly go, and I'm saying, well, what's that put going to be worth? Well, clearly there are instances in here when the stock moved much more violently than other periods, and those periods are almost always going to be in and around earnings, because that's kind of the big announcement. If I go like this, I go 5 years, and I'm just going to show you this chart, and I'll get rid of the options premium just to make things clean. And I said, okay, do you think you can figure out when earnings took place on this chart? This is just a chart of volatility. So whenever the line gets higher, that means there was more short-term volatility. You would say, oh, I'll bet you there was one here. I'll bet you there was one here, here, here. Not, this is all surprisingly quiet, but there was probably one here, here, here. And we've got 5 years, so we should be able to figure out 20. And I guarantee you it's going to be all of these events, right? That's what these things are. That's when stocks start to move. So the reason I was doing the one on the earnings calendar first is because I was really just trying to take a look at that in the general sense and saying, does it make sense to sell options here or now, knowing that the event is upcoming? The separate issue is, does it make sense to sell puts at this level in general? And the answer to that question turned out to be yes on both counts. So it turned out that it was a fair price to sell those if you went back to all of the company's reported earnings history and how sharply it moved and went up sometimes and down sometimes. And it also proved to be good just in general, if you had the opportunity. That will not always be true. It's going to be true when the options market is implying very big moves and the stock historically hasn't moved that much, or at least has not moved that much over the time interval in question. And this is something that I also encourage people to do, which is Bruno. I'm going to see if I can find time. I'm going to see if I can find this paper for you guys because I think it's really interesting. So Bruno Dupierre, who's the chief quant at Bloomberg, he, here's something from Carnegie Mellon. It's probably the same presentation, is it? I encourage you to look up his work. One of the things that he talks frequently about, and I'm not sure if he does in this presentation, hedge daily. Yes, okay. So volatility arbitrage, daily, weekly. One of the things that he observed was that volatility in the day-to-day sense doesn't actually translate as neatly as the models would suggest they do into longer periods of time. And that favors options strategies which are short premium of more than a week. And what I mean by that is that he basically was able to divine that if you divided the movements by the square root of time, which is the way you're supposed to be able to translate standard deviations for periods short and long, into a common denominator, if you will, that the day-to-day and intraday volatility was higher once you annualize it than it was if you went week to week, month to month, like that. And one of the things that doing the kind of analysis that I just was suggesting, which is you take a look at a fixed interval and roll through time in this way, and then compare what the options would have been worth in this kind of, and what is real options pricing? It basically takes all of these outcomes and then just calculates the mean value of it and then compares it to the price in the market, rather than assuming that you can continuously hedge the underlying events. Great. Okay, so we have, thank you for putting that up on the lower third. That's something worth checking out. When that works, that's when selling options premium is a good idea. And I guess the point I'm trying to make here too is that this is something that you can do. Like, you don't need some fancy tool to do that. Some of it looks kind of mathy, and there is some mathiness to it from time to time. But doing an analysis of returns over fixed intervals is something that, as long as you have the time series in Excel, you can do it. I mean, one can hardly imagine what would have been like to try to figure this stuff out in 1973 when calls first got listed on SIBO, or in 76 when they first started listing puts. Very tough work. But nowadays, with Excel and a link to Yahoo Finance, I think Yahoo Finance has an API. Maybe someone can get into my ear. I don't know if that thing still works, but you can pull a lot of this information down. It's really quite helpful. All right, so now let's take a quick peek. I want to see what other big news. Oh, you know what? I think it probably deserves a mention. So we had Carter Worth on the channel, was it a week ago? And I think we hinted at the time that he was going to be making an announcement sometime soon, but there was, I guess, a quiet period of sorts. It's not quite the same thing as a quiet period like when you have an IPO, but if you have a new security coming out, you're not supposed to talk about it until it's out. Well, his is out. Ticker WRTH, just listed yesterday. It is the Worth Charting Options Income ETF. And in effect, I'm just going to show you quickly the kinds of things that he does. What he likes to do, and I think he talked about this, is that when you see stocks that had big, sharp moves, he looks for opportunities to sell premium after something like an earnings result comes out. So we talked about Qualcomm going into the print. Nice time to be short premium. He's less inclined to take the risk because he doesn't want to see those big drawdowns. He'd rather get a steadier result once he thinks that a stock is going to be range bound. And so he sells both upside call spreads so that you don't ever have unlimited upside risk, and downside puts, and does it on stocks that are moving about. If we look at the Russell or the S&P today, because it's always going to be probably in large cap stocks. Oops, I put Worth in there. That's not what I wanted. SPX. We got some earnings moves today. Yeah, so we had a big down move in Hood over here. And we had some big upside moves over here. So very likely that these are the types of things that he's going to be looking at. Looking for catalysts, getting more insight, selling some premium. But the other thing I thought that was really interesting, and the reason I would congratulate him, he's not on right now, so I can't tell him, and that is that it's not that common for newly listed ETFs to trade the kind of volume that this one did, 700,000 shares today, 708,000, and it traded, I think, nearly 300,000 yesterday. So, million shares traded in the first couple of days. That's pretty exciting, pretty interesting. So hopefully we'll get him back and he can talk a little bit more about it. Needless to say, since a lot of the strategies that we run are options income strategies, we are like-minded. The principal difference being that we're generally almost always options premium sellers. There might be something like a hedge in one of these funds, but more often than not, you're long the underlying stock and selling some premium against it. Okay. Now, this has been exceptionally brief because I usually go for a full hour. It has been 45 minutes. But I do have some other personal matters to attend to other than all the busyness I was just talking about and the fact that there's all these earnings. But one of the producers has a son that does track. They have a big track meet. He needs to get to that. And as it happens, one of my sons on the opposite coast also does track. He has 3 events: the 100, the 200, and a relay, I think. And I have to get to that. So between the two of us, you guys can hang around and just you guys can hang out here, and I can leave the camera on, and you can stare at the colorful graphics on the monitor behind me, or you could wait until we do this again, which I think is probably the more advisable course. So I hope you found that helpful. If you did, like and subscribe. Put your questions into the chat. And just as a quick reminder, I am in New York all week next week. I'm on the New York Stock Exchange all day Monday. I will be doing Fast Money from the NASDAQ Stock Exchange on Wednesday and Thursday. And we will try to put out a live stream, possibly, if I can, but it's not likely because we really are packing in a lot of meetings, and I haven't even been to our New York office yet, which is apparently Bryant Park, so not far from the NASDAQ, so that'll be convenient. But unfortunately, it's not convenient for doing live streams while I'm on the road. So if I can, we'll put a post on my X page probably about it, and we'll schedule it on YouTube. But I think it's likely that we will not. So until a week from Monday, I hope you all trade well, and I hope the markets do well. And thank you, of course, as always, for watching. We'll see you soon.